With the S&P 500 down almost 10% from its all-time highs, now is probably the time to start being greedy. And that's just the S&P 500. The Nasdaq has dropped 13% from its all-time highs, which means there's a lot of deals likely out there in tech. So in today's video, we are going to be taking a look at a number of different companies. We're going to look at their top-line revenue numbers, bottom-line EPS numbers, as well as their valuation. These are companies, two of which that I'm actively buying, and a few that I am watching and could potentially add to my portfolio in April. And of course, at the very end of this video, I will be sharing the YouTube portfolio. That is the portfolio that we track on this channel, so stay tuned to see the moves that I'm making there. Thank you guys so much for watching. If you do enjoy this video, make sure to drop a like down below and subscribe for more videos like this one. The first stock we have up here is none other than Google. This is a very popular stock in the markets. However, over the last month and a half, it has fallen from around $205 per share now down to $155 per share. There has been concerns around Google as to whether the company would be broken up by the FTC. However, right now the biggest thing is just concerns in the broader market. We can see that their revenue is still increasing by around 12%. They currently have a trailing 12-month revenue of $350 billion, and their quarterly revenue hit an all-time high last quarter of $96.5 billion. And part of the reason that Google is down so much has to do with their underlying business model. At the end of the day, Google sells advertising. What that means is if we do head into a recession, a lot of companies look at their advertising budgets as one of their first budgets to slash, and that ultimately has a big effect on Google. We could see that their EPS over the last couple of years has increased massively. We could see consistent trends of 30% increases year over year on their bottom line numbers. Their trailing 12-month EPS is sitting at $8.04 on a GAAP basis, and on a quarterly basis, we can see that they have consistently been able to increase their EPS over the last couple of years. Back in 2022, when again there were a lot of fears around recession because of interest rates increasing, they saw a big hit to their bottom line numbers as well as a hit to their top line numbers. And because of the volatility of the advertising business, investors often are not willing to pay a premium like they do for other big tech companies for Google. We can see that on a forward P/E ratio basis, Google is only trading at a 17.33. This is much lower than a lot of other Meg 7 stocks. Even over the past year, the highest forward valuation that they've traded at was a 24.21. The Nasdaq over that time period has consistently traded above a 25 forward PE. And a lot of super investors are betting big on Google as well. We can see that there are portfolios that hold well over 10% of the portfolio value just in Google shares. Bill Ackman being a notable one. He's got 11.39% of his portfolio in GOOG. Keep in mind, Google has two ticker symbols. They have GOOG and GOOGL. This is just GOOG. So right now, Bill Ackman holds 11% of his portfolio in Google, even higher when you consider GOOGL. You also have other super investors. You can see one of them holding 21.38% of their portfolio just in Google shares. Another one, almost 20% of their portfolio in Google shares. So this is a very popular stock, not only amongst retail, but also amongst super investors. The second stock we have up here, and this is also one that I am actively buying, is Microsoft. Microsoft is down 9.5% year to date. This is not even their all-time highs. If we look over the last year, this stock is down well over 10%. Its all-time highs were achieved back in July of 2024 of just under $470. From that point till now, the stock has fallen by almost 19%. And in my opinion, the reason the stock price is flat over the last year is because it is following the same trend as their EPS numbers. If we look at EPS since 2023, they have basically had numbers around the $3 mark. That is due to the fact that they are investing so much money into data centers, AI, and cloud. At the end of the day, that is impacting their bottom line. However, once they get through this investment period, I am fully expecting their EPS to shoot up in a substantial way. And the effect that these investments are having on their bottom line numbers is clear when you look at Microsoft's top line. Over the last 5 years, they have been able to consistently grow their top line numbers. And even over the course of the last year, their top line has increased by over 12%. And the reason that Microsoft's stock has traded basically sideways over the last year is due to the fact that investors are starting to get impatient. They want to see the results of these investments hitting the bottom line numbers. And right now, what they have done is they have traded Microsoft's valuation down in a substantial way. It's currently trading at a forward P ratio of 25.32. We can see that the high over the course of the last year has been a 33.33, so much higher than the current valuation. And that's personally why I am buying more Microsoft, because right now the stock to me is trading at a very cheap valuation compared to where it has historically traded in the past. If we see Microsoft trend up over the next couple of years based off 2026 EPS numbers and a potential PE ratio of 33, that means the stock could be at $500 per share by the end of 2026. That is around a 30+% upside from the current stock price. The next stock we have up here is none other than Uber. Uber is a stock that I don't currently own, but I have owned it in the past. Right now, the stock is actually up around 15% year to date. A lot of people are afraid of Uber's business model getting disrupted. This has to do with the autonomous vehicle market. We have people like Waymo as well as Tesla talking about getting into this market, and people are worried about how this could actually impact Uber. Because of that, the stock has gone flat over the last year, down almost 5%. However, we have not yet seen this impact Uber's numbers. Their trailing 12-month revenue is sitting at almost $44 billion, up 20% year over year. And they have consistently been able to grow their revenue by anywhere from 10 to 20% over the last 2 years. And now over the last 2 years, they have consistently been able to show profitability over a trailing 12-month basis. They do still have one-off quarters where they have put up negative EPS numbers. However, this consistent trend of positive EPS is also very promising for investors. The reason I haven't yet bought Uber is because I don't actually believe that the market has yet priced in these fears. I don't believe these fears are actually warranted, and that's why I think Uber is still trading at a relatively decent valuation. Right now, their forward P ratio is sitting at a 27.25. In my opinion, if these fears were actually being priced into Uber, I think the valuation would be much closer to a 20 forward PE ratio. The next stock we have on this list is Amazon. Amazon year to date is down around 12%. We can see that they hit an all-time high back in February of $242, and from that point till now, the stock is actually down by over 20%. You're probably starting to look at this list and wonder why you're watching this video, because it's just a bunch of big tech companies. The reason for that, though, should be very clear. These companies have invested a ton of money into AI infrastructure. That has beaten down their EPS numbers. At the end of the day, when they turn off these investments and start actually utilizing this technology more in their business, they should see a massive increase in their bottom line numbers. In 2024, Amazon put up $5.53 of EPS. Analysts are expecting that to grow by almost 15% in 2025 to $6.34, and they have that growth accelerating in 2026 to almost 20% growth of their bottom line to $7.60. And in my opinion, these numbers are a little bit low. 2025 may be accurate. They could come in around this $6.30. However, in 2026, I think we will see Amazon start capitalizing on AI in a major way, and we could see EPS numbers closer to $8 to $8.50 per share. It's not very often that you see Amazon trading at a forward valuation under 30, but right now their forward P ratio is a 29.24. We can see that over the course of the last year, they have traded at a forward PE of as high as a 42.55. And if we're talking about numbers that are beating analyst expectations in 2026, this forward P ratio is much closer to a 25. And the last stock we have on this list is Adobe. Adobe is down over 12% year to date. Over the last 5 years, Adobe has had a very rough time. We can see that the stock was trading at almost $700 per share in November of 2021. From then till now, the stock has dropped by almost 44%. 6%. It hit a recent low of around $275 back in 2022. However, it rebounded nicely to around $630 per share as of February of 2024. But over the course of the last year, this stock has traded down by over 23%. And the reason we have seen Adobe fall so much is due to fears around AI disrupting their market. However, over the course of the last 5 years, we have not seen that at all. Adobe is one of those companies that shows a very consistent upward trend on their top line. We can see that right now their trailing 12-month revenue is sitting at $22 billion, and they are consistently growing their top line numbers by around 10% over the course of the last 2 years. Adobe's bottom line has not been as consistent of an uptrend. Over a couple of years spanning from 2021 really until the end of 2023, their EPS numbers on a trailing 12-month basis were basically flat. However, more recently, we have seen their numbers increase in a substantial way. Their trailing 12-month EPS as of their most recent quarter is now sitting at $15.14. And what these fears around Adobe have really done is they have constricted Adobe's valuation. Their forward P ratio is now sitting at an 18.90. Adobe's a company that, because they have shown consistent growth, is typically traded at a valuation closer to a 25 to 30, even at times trading at a 30 plus valuation. Again, this has to do with the stability of their business model, but right now, because that has come into question, we have seen their valuation trade down in a major way. And in my opinion, I think Adobe should be a main beneficiary of AI. If they're able to integrate the technology into their platform to make it more user-friendly, they are already known as the studio or the place to go for anything like photo editing, video editing, whatever it may be. That is super important, and as long as they can integrate AI and use it effectively, I don't think a lot of other companies like the Googles or Microsofts of the world that have little fun AI tools where you can generate images are not going to compete with Adobe to the same extent as investors are expecting. But let me be fully transparent with you guys and show you where I am putting my money right now. This is the YouTube portfolio, and it is currently sitting at a value of $58,078.54. And these are the positions that we currently hold in the market. Our most recent buys have been into Google and Microsoft, as I previously mentioned. Our Google shares right now are sitting at 29 for a total market value of just under $4,500. This is the only position currently that we have in the red, down 6.5%. I also hold Alibaba, Apple, Microsoft, Palantir, PayPal, SoFi, Super Microcomputer, and Visa. Right now, Super Microcomputer has dropped significantly, only up 7%. We have also seen PayPal pull back quite a bit, only up 8.5%. And Microsoft, as I mentioned, I have added more to this position. We are currently only up 8%. And on top of those positions, I do hold two dividend ETFs, SCHD and VYM. They make up just under $29,000 within the portfolio. And what I have decided to do is I just received a dividend from VYM, and I have put in a full sell order on this position. All 118 shares I will sell as of Monday morning, and that will provide me more cash to distribute into the market. And when I receive the dividend from SCHD, I plan to sell out of that position as well. What I'm hoping happens over the course of the next 1 to 2 months is we see the market drop by another 5 to 10% at the very least. What that will allow me to do is deploy more of my current cash into positions like Microsoft and Google. If we see some other stocks fall significantly, I could potentially be open to more speculative plays like maybe an AMD, which we have talked about on the channel, as well as some of the other positions that we've talked about in this video like Amazon, Adobe, and Uber. But right now, what I need to do is I need to build out more cash, and that's why I've held these dividend ETFs, is they have held up well as the market has dropped. Ultimately, what I now can do is sell out of them, and I will have plenty of additional cash to deploy into individual stocks. But let me know in the comment section down below what stocks you are looking to buy in April. Thank you guys so much for watching. Keep in mind, don't buy a company just because I talked about it. Make sure you are doing your own research. Thank you guys so much for watching. If you did enjoy the video, drop a like down below and subscribe for more videos like this one. And for the joke of the day, why did the frog take the bus to work? Check the comments down below for the answer. Thanks for watching.